Well, investors are turning to this week's retail earnings as a proxy for the health of the U.S. consumer. The U.S. economy may still be in recovery mode, but that recovery could be uneven and growth slower than expected. Joining us with more, JoAnne Feeney, Advisors Capital Management Partner and Portfolio Manager. JoAnne, it's good to see you as we are looking at these markets that are bouncing a little bit today. We've got more retail earnings this week that could give us a little bit more insight into what the consumer is doing. How are you thinking about, in the wake of last week's numbers, how are you thinking about consumer spending and how it's informing your strategy?
Yeah, good morning, Julie. I think that investors have to recognize that there are multiple types of consumers out there. When you look at the aggregate situation, consumer balance sheets are very strong. They have a lot of savings still. Their debt obligations as a percent of discretionary income is pretty low. And more of them are getting jobs and wages are rising. On the flip side, inflation is also high, and particularly in energy and food. And so when you look at the consumer, if you look at the lower end consumer, they're the ones really feeling the bite of that on their budgets. And so hence, we saw some pain over at Walmart and Target. Mix shifted a lot in what consumers were buying, and the stores really were not prepared for that. Plus, a lot of stores are seeing higher wages. But it's not a uniform problem. It really depends on whether the stores can pass on higher prices and whether their customers start to have to trim back on discretionary spending. And, TJ Maxx, for example, is likely to pick up some share. Right. As folks switch from middle market department stores down to the off-price company like a TJ Maxx.
Well, I'm glad you brought that up, JoAnne, because I wanted to dig into that a little bit more, the substitution effects that we're starting to see, not only at the lower income, but also in the higher income brackets, too. I think everybody here is feeling the pinch. I'm just wondering what kind of anecdotal evidence or aggregate data. You just mentioned Walmart just having its worst day since the '87 crash. So did Target. What else are you seeing here in this space?
Yeah, one thing we're trying to evaluate is how much pain is being felt from inflation, but also from the wealth effect of lower stock prices. There's been a pretty big pullback, and that has hurt the wealth of the higher income folks that tend to dominate the stock market. On the other hand, housing values have been rising pretty substantially, and that has a positive wealth effect on spending. So, for example, we saw Home Depot do quite well. And so it really depends where in the market. I do suspect that some of the very low end retail operations are going to suffer from declines in spending and a mix shift towards the essentials only, which don't tend to be as high margin. Whereas, in the middle market, we could see consumers trade down to the off-price guys. So it's really a tough place. And then you have wages going up, which are really potentially constraining margin. So it's a tough space to invest in at this point. But we think some of the ones that are going to fare the best are sort of in that middle off-price area, like a TJ Maxx, or in the upper range, like, say, a Williams-Sonoma, which got hurt recently, but really serves a part of the market we think will be pretty resilient, even in the face of this higher inflation.
So, JoAnne, looking beyond the retailers, we've been looking at this reallocation that you referred to in your note to us, which we've been seeing now for the past almost 6 months, really, where we have seen money come out of tech, come out of the pandemic trade. How close are we to being sort of at the end of that digestion period?
Well, that is the big question, Julie, isn't it? We've been watching the dynamics affecting valuations. First, it was interest rates going up, and that's what got signaled back in early November, which really triggered the reallocation away from higher multiple stocks. And then, it looked like things were getting, fully digested, but then risks increased. The risk from the war in Ukraine, the risk from the China COVID lockdowns, which are really continuing to extend out the period it's going to take for supply chains to recover. So between higher rates and whether they're going to go higher from here and those elevated risks, we have just seen valuations come down. Now, we're down quite a bit, but I did want to point out one thing to keep this in perspective. Relative to pre-pandemic, the S&P 500 is up over 20%. And I'm talking January of 2020. And relative to that period of time, the NASDAQ is up 33%. So the decline has been painful recently. But over that period of time, that's not a bad, average return. And so, again, the pullback has been painful. Valuations have really come in, we think, creating a lot of attractive opportunities. And even some apparently high valuation stocks like a Palo Alto. Obviously, they reported last week, they are still seeing very strong billings, 40%, and their valuation is a little bit hard to interpret because it's more of a cash generation business and cash is leading earnings. So it's a company, for example, that we expect to grow into their PE valuation.
And JoAnne, we got some merger news today. We've been talking about Broadcom and also VMware, and all of this kind of fits in. You're talking about, we've been talking about some of these stocks going on sale, really beaten down in price. I'm just wondering, do you see any mergers on the horizon, any industries that that are catching your eye right now?
Well, I think this VMware Broadcom tie-up is really interesting. The complementarities between those two businesses are very strong, given the infrastructure software that VM provides. More broadly, I think that software has become particularly attractive. I'm not going to call out any particular ideas we have about which companies might be acquired. But, something like an Encino or a Q2, that one was also in the news, potentially rumored. And those are foundational technologies on the software side for making financials more efficient, whether it's banks or whether it's mobile front ends. They're relatively small companies. They could be targets. Another one in the defense space is Kratos. They make drones, which we're going to see, I think, an increase in spending towards from defense departments all over the world. So those are a couple. I would look at the ones, obviously, that have gotten beaten down among the most, but also have a very strong competitive position in the end markets that they serve.
All right, we're going to have to leave it there, but appreciate your thoughts. JoAnne Feeney, Advisors, Capital Management Partner and Portfolio Manager.